Hi, everybody. Good afternoon. Thank you for joining in. Just quickly, I hope I'm audible and you all can see the screen. We are having some trouble sharing our screen, but I think till they figure it out, I think we can start. So quickly, right? We won't keep this very long. The point is to keep this short and crisp. So, as you might be aware, this what we're trying to cover today is an analysis of the proposed Hire Act, which is the Halting of International Relocation Employment Act, where basically we will take you through what the proposed act says, what impact it may have if passed in the current state, and also we will take you through the possible way arounds that currently come to our mind at this time. Right. So quickly, my colleague Dhairya will be joining us in this session. If we can move on to the next slide, right? So as I mentioned, we'll first look at what this act says. We'll go through the impact, and then we'll open the floor for any questions. So quickly to spend 5-7 minutes on what exactly is this Hire Act, right? So this act was presented in October by Senator Bernie Moreno in the Ohio state. The objective of this act stems from the larger objective of Make America Great Again, and they don't want to kind of outsource anything outside of the US, right? So this kind of stems from that larger global political motive, right? And the objective of this particular act is to discourage US companies from outsourcing jobs overseas, right? Now, to summarize quickly what this act says, currently how the bill rather reads is that any outsourced payments that a US entity makes to any foreign service provider, right, for any work which could directly or indirectly benefit US consumers, then that payment will be subject to a 25% excise tax. Okay. So, for example, a US entity is paying 100 rupees to an Indian entity for any outsourcing work, then US will have to pay 25 rupees as excise tax on that payment over and above the 100 rupees that it pays to the Indian entity, right? The second impact of this is that, sorry, not impact, but second proposal which is there in the bill is that the money that is paid by the US entities to these foreign service providers will not be allowed as a tax deduction, right? So basically, it means that there will be an increased tax on that because of the non-availability of the tax deduction, depending on which state you are a part of, right? Whichever state the entity is a part of, then the federal tax and the state tax of that particular state will also increase because of the non-availability of the tax deduction, right? One more thing that it says is that the 25% excise tax which will be collected by the US government will be used to create a domestic workforce fund, right? Which they are saying is then going to be used to finance reskilling and apprenticeship program in the US, right? So this further kind of tells us more about what they are intending to do, right? They don't want US entities to outsource any services to any foreign parties, right? And this is relevant for us because India as a whole has many back office operations, has many IT service companies who are heavily reliant on US as their primary client, right? Now, if this were to come into force, then what happens is all those companies will be impacted. The Indian entities having US clients will be impacted, right? Currently, as the bill stands, it says that it's effective for all payments made after 31st of December 2025. However, I want to again caveat that this is still in bill form, like it is just something which has been introduced. It has not been passed, so it doesn't currently apply. But basically, what the bill says is that if at all this were to pass, it would apply to all payments made after 31st of December 2025, right? The bill also has heavy reporting obligations on the US entity, which means that the US entity has to report these outsourcing payments made to any non-US parties to the US government. And they also, if they fail to report or if they fail to pay this tax, then there are heavy, heavy penalties which are currently proposed, right? As of today, the status of the bill is that it has just been sent to a finance committee for review. Frankly speaking, the chances of this bill being enacted in its current form are fairly low. Even if it does get passed, the industry senses that it will get passed in a much more diluted format, or it may not get passed at all. But the way things stand currently, it is important as Indian companies who have US clients to kind of be aware of this bill, and also be a little prepared in case this were to get passed, right? Now, before we move on to impact, right, I just want to spend 2 minutes to read the definition of outsourcing payment, right? Now, in gray, if you can see on the screen, we have reproduced an extract from the bill, right? What I wanted to kind of drive home here is that um, the enormity of the definition, right? Like it is very, very wide. Okay, so the loophole or any way in which you can get out of this outsourcing payment is kind of very low, right? The way the currently it is drafted, right? So if you read it, it says the term outsourcing payment would mean any premium, fee, royalty, service charge, or any other payment which is made in the course of business to a foreign person with respect to labor or services, the benefit of which is directed directly or indirectly to consumers located in the US, right? So basically, it means that any payment, be it in the nature of royalty, fee, service charge, anything, which is made by US entities to any non-US entity, okay, the end use of which goes to US customers, then that kind of gets covered in this 25% tax. So yeah, so this is just a little bit about what it is, how it stands today, and what was the intent behind it, right? Hand it over to Dhairya from to take you through the real impact in numbers and possibly what could be the mitigation strategies.
Thanks, Priya, for putting across a context on what this proposed act means for the outsourcing industry as a whole globally, including India. So, as Priya rightly mentioned, the intention of the current president of US is to make America great again by onshoring all the work that is being done offshore at, and ensure that whatsoever work pertains to US is being done in US itself rather than outside of US. With this very intention, this act is proposed by the legislator. And now, if you were to see the impact in numbers, so we have here considered one example for simplicity, wherein we are saying that, say, for instance, an Indian party is having receivable of 1 lakh USD for provision of outsourcing services to a US based client, wherein the said fees would have been received as is without any top up. But now, presuming if this higher act is enacted in its current shape and form, then there is a proposed levy of 25% excise tax, which the US vendor would have to pay separately to the tax authorities or government authorities in US. This would make the total cash outflow for the vendor 1,25,000 US dollars. And to add to it, the law also proposes that it would not allow this payment to Indian party as a deductible expenditure for the purposes of state and federal tax laws. So this is very important here. Unlike India, US has a system of federal and state corporate tax laws. So both combined, they file their return of income, wherein a certain percentage of overall tax is to be paid to state authorities, while a certain percentage of tax is to be paid to the federal authorities. Accordingly, while the federal corporate tax rate is uniform across US, that is 21%. So continuing with our discussion regarding allowability of expense, so the law proposes to disallow any such payment for outsourcing from a US entity to outside US for the purpose of US entities corporate tax computation, wherein, as we discussed in US, there is a dual corporate structure, one being federal, that is the central level, and one being state level, wherein the corporate tax rate for US federal tax purposes is 21% across the US, while for state corporate tax, there are different rates for different states. Say, for instance, for Delaware, the rate of corporate tax is somewhere odd of 8.7%. However, that tax is applicable only when any entity is actually conducting business out of Delaware. So in the given illustration, what we have assumed is, considering if the entity is incorporated in Delaware and is not conducting any actual business physically from Delaware, then there should be no taxability for that entity in Delaware, and hence we have considered nil disallowance so far as Delaware state taxes are concerned. Accordingly, for the disallowance on federal corporate tax, the total outflow or cash outflow on account of this proposed US Hire Act is 46,000 USDs, which makes the effective increase in overall cost to 46% over and above the base payment. Bear in mind, this is presuming there is no disallowance so far as state taxes are concerned. If at all there is a disallowance for state taxes as well, then this figure of 46% can go up to 56 or 58% as well. So this was the illustrative impact of the proposed Hire Act if it were to be implemented in the same shape and form. However, to explain you bit on the structures that might be impacted for, then it is interesting to once again go back to the definition of outsourcing term, outsourcing payment. It says that the term outsourcing payment here means any premium, fee, royalty, service charge, or other payment made in the course of trade or business to a foreign person, and with respect to labor or services, the benefit of which is directed to consumers located in the US. So it is interesting to note here that the definition is wide enough to cover any and all sort of outsourcing related payments made by US entities to entities globally. It does not restrict to entities who are related parties, unlike transfer pricing, wherein transfer pricing provisions are applicable only if the entities qualify as associated enterprise. Here it says even if the payer and payee are unrelated parties, still this Hire Act implications would continue to apply so far as the payment is made for outsourcing services. So what sort of current structures might need to reevaluate their businesses? Then few of them which come to my mind are cost plus entity structures, wherein India, the US based entities set up a subsidiary in India for providing back office support services to the US holdco by employing relevant IT personnel at Indian subsidiary level, and in turn the Indian subsidiary bills the US holdco with a certain markup. In such business models, since the payment to be made by US holdco to India subsidiary would qualify as outsourcing payment, this kind of payments would also have to be re-evaluated where this Hire Act is implemented as is. In addition to this, any sort of payment being made for
back office support services from a US entity, say for instance in relation to bookkeeping or outsourcing industry so far as accounting and taxation is concerned, wherein the US based entities outsource their bookkeeping and taxation related work to India service providers. So such kind of payments should also qualify as outsourcing payment, leading to implications under the proposed Hire Act. And apart from this, all such GCC delivery centers for the US based companies who are currently operating out of India would have to reassess their structures in order to mitigate the impact of the proposed Hire Act. So this was broadly as to the Hire Act. Happy to answer any questions that the audience may have.